Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. You know, one of the things, and join me today, by the way, Phil Kosmala with Tabor Kosmala out of Chicago. And Phil, you know, great points you were making before the break. And one of them I wanted to touch on, you mentioned looking at the technicals, basically the fundamentals of what's going on in the markets and what if any adjustments you might make to portfolios when at a time like this, or in particular, as you said, it's not that people get scared. You know, when they see things like that, Ukraine or Russia, it's natural for, you know, all of us to wonder, well, where's this going to go and how serious is this? And, you know, and get fearful and thinking, you know, in that acting out of fear, maybe taking our money and just kind of want to go bury it in the backyard, you know, as opposed to staying invested, being calm. And that's why I like the perspective that you give. But if you could also talk a little bit about those fundamentals and how you see that. You mentioned the, I think you were leaning up about the stop loss potential. Maybe you could talk a little bit about that as well.
Yeah, Hank, I think the weight of the evidence is still telling us that the overall global economy is in great shape. We look at the U.S. consumer and retail sales hit an all-time high. We look at corporate America, profit margins are the highest they've been in the history of the country, 17% operating margins for the United States. You have record cash sitting on the sideline. There's a lot of cash to be deployed in capital investment as well as from the consumer's balance sheet. You have negative real interest rates, meaning people are eroding 7% of the value of your retirement nest egg by sitting in cash. Historically, Hank, those have not been signs of a recession. But this time, could it be different, Hank? Absolutely. When we look at the impact that Russia has, we produce as a global economy 100 million barrels a day, and Russia's 10% of that. So Russia's a big producer. If we saw a massive oil spike, that would clearly change the direction and profitability of corporate America and the global economy. And it would also put such a dent in consumer balance sheets that maybe this does drive us into recession. So we can't rule that out, Hank, which is why we do also rely on our technical indicators. And we have a basket of indicators, but three primary ones that we look at. One of the three has forced us to take a little bit of risk off the table. One of our longer term moving average trends broke during this past week. The other two, our stop loss indicator was teetering yesterday, but rebounded, and we stayed in the market with that indicator, and hopefully we get some sort of detente with Russia, Ukraine. And then we'd expect that you'd see a resumption of the trend, which is the strengthening economy starting to bolster equity prices.
Right. And this is one you mentioned as far as how much, I mean, the 10% corrections that we typically see about every 15 months. This basically is, if things smooth out, as you said, then this is likely to just be another one of those type of routine, if you will, corrections that we typically see.
Yeah, Hank, and I think, you know, one of our charts that we'd sent over, it might be good for the viewers today. 10% corrections are very normal. They happen every 15 months for the past 100 years.
Let's go ahead and put this one. You've got this macroeconomic backdrop still constructive. Bear market, so this next slide, if you will, bear markets without recessions are rare. And
yeah, Hank, and I think this one is the proof is in the pudding. And I mentioned earlier that it's really rare to have a major drop in stock prices without a recession. And we look at a basket of 24 indicators, and so they're summarized here. And right now, very few of those 24, in fact, only 2 of the 24 are signaling a recession in the next 12 months. Excellent. And so as a result, our bias is still that we should be buying this dip. And I think when we go back in the annals of time, Hank, at least you go back to 1980 even, we've had 33 10% corrections in 40 years now. So that works out to about once every 15 months, Hank. Yeah. And returns over after those corrections, when people are running, and Warren Buffett famously said, be greedy when others are fearful and fearful when others are greedy. Yeah. And I think we're seeing a lot of the signs of fear with cash on the sideline, record cash in money market funds. People are clearly frightened and unsettled by the uncertainty with the Federal Reserve, uncertainty with Russia, Ukraine, and what that means to the global economy. But Hank, returns over the next 12 and 24 months have averaged 20 and 40% respectively after we've had these 12% corrections. That pendulum of fear and greed, when it swings too far one way, it usually snaps back in a notable fashion.
Let's take a look, in fact, at that new next slide, Phil. This one, to your point about corrections now without recessions, are shallow and short-lived. In this, again, as you said, that corrections every 15 months on average. That's just part of being in the market. And one has to accept that amount of volatility. And at the same time, with clients, they just need to be thinking in terms of ways that they can manage their risk and to their comfort level. What kind of risks they're going to be comfortable with and how to then set up their asset allocation model, for instance, to accommodate that. So if the market corrects 10, and that's outside your comfort level, as an example, you might want to be in say a 60-40 portfolio where you've reduced that risk down by almost half to where you're looking more at maybe a 6%, 5 or 6% correction in your own portfolio.
That's right, Hank. It's a byproduct of your risk tolerance, the amount of time that you have until you need to tap your nest egg or your retirement vehicles, whether it be a 401k or an IRA. But what do we know is that, those 10% corrections, when they happen, the blue dots on the right-hand side, Hank, are periods where we're not in a recession. Those are usually very shallow and very short-lived. The market gets back to fundamentals in understanding profitability, strength of the global economy, and you see a snapback ultimately that's reflected in stock prices. But when we're entering a recession, that's when you see those dots in the red on the right-hand side. Those are your 20, 30, 40% declines that last for anywhere from 300 to 500 to 600 days, meaning that they're persistent for a year or two, like we saw in 2000. Like we saw in 2007, 2008. And Hank, back to your initial question, the weight of the evidence is telling us that's still not the case. If we do see this Russia-Ukraine situation spill over or intensify, and that causes a spike in oil prices, that clearly would change the dynamic. But I think we have to operate with what we know now, which is this seems like a relatively limited purpose incursion by President Putin to try to take over, destabilize the Ukrainian government, and re-centralize power and create that buffer. But there is a clear red line from what NATO has established in the UN in terms of invading one of those NATO countries. Anything west of Ukraine, unfortunately, could cause that spike. But Ukraine, I think what we're learning over the past couple of days, Hank, is that Ukraine itself probably isn't enough to induce us into something more meaningful at this point.
Well, and this was one of the areas as well for clients, like you said, that hopefully this is a relatively short-lived impact overall, in that it's already, in fact, hopefully going to improve based on this potential for peace talks. But for our clients, what we're concerned about at this point, when you get into volatility and you talk about how to reduce volatility or how to manage risk basically in a portfolio, the current concern is going to be we're going to be pulling money out, and we're going to be thinking in terms, for my clients in particular, retirement, age, when you're already in retirement, when you're on a fixed income, when you are dependent upon your investment portfolio to help plug in the gaps in income that would be there from, let's say, if you got you're going to have Social Security likely, of course, may or may not have a pension, any other sources of income, bake that all in. Now I've got to pull money out of my investment portfolios to my retirement accounts, typically, to support my lifestyle. How to go about that in a time like this with volatility? We talk about ways that we can, one, manage a risk, meaning reduce that volatility down, asset allocation being one of those, of course. And then we also talked about your stop loss, Phil. And you mentioned, I think, a little bit there earlier about I think one trigger may be occurring and getting a little bit of a pullback from the equities. Is that, did I get that right?
That's right, Hank. But our stop loss indicator, which is our primary indicator, when we look at that historically, when markets have dropped by more than 12%, historically that there's been a higher probability of further panic in markets, Hank. And we were teetering on that yesterday. In fact, intraday, we broke the 12% threshold. But ultimately, Hank, we rebounded in the back half of the day. I think markets were realizing that this does look like it's a situation that, from President Putin's perspective, is limited to Ukraine at this point in time. We bounced back pretty firmly yesterday and have a decent start today here. Ultimately, if we go down by more than 12%, we will de-risk portfolios further.
Right. And this is one of the areas, but hopefully we're getting back to fundamentals, which brings up the bigger concern as far as the economy and in particular what it means with regard to the Fed. And we want to dig down into that a little deeper, but first we're going to take a break. When we come back, I'd like to get more comments here, and we'll talk about your side on pace of Fed tightening is still going to matter the most. So first a break. Join us here. We'll be right back on the Retirement Report.